I'll split this talk into three sections. I'm going to look first at the personal tax changes, then I'm going to have a look at savings and investments, and then I'm going to finish off by looking at changes for business. So look first at personal tax changes. I think for the avoidance of doubt, none of the income tax rates changed. There was a little bit of speculation that we might see a penny off something as a big election giveaway, given that he's a little bit ahead of where he thought he might be. But we haven't seen anything like that. So what we basically got is just some adjustments in the personal allowance. I did see a lot of articles saying that they might put the allowance up to 10,800 next year rather than the promised 10,600, but they're sticking with the 10,600. And it's gradually going to go up to 11,000 over the next couple of years. It doesn't seem that long ago since the personal allowance was only about £5,000 or £6,000, so it has gone up an awful lot over the last few years. And if you look at the higher rate threshold, that's actually stayed pretty constant over a number of years, and a lot more people have gone into high rates, and there's been a lot in the press about that, so they're finally starting to move that rate forward as well. And that's going to go up by about £1,000 over the next couple of years, so that's good improvement. That hopefully takes some people out of high rate tax around borderline. So that's tax rates and personal allowances. So if we look at one of the documents that came out on budget day, there was a rather dramatically named document called the end of the tax return. Basically, at the moment, the revenue gets an awful lot of information. So when you send in your tax return, they already have on their screens things like the P60, P11Ds, that they know about your bank interest. So there's a whole range of things they already have information on. What they're actually going to do is put that information onto a digital tax account. So for a lot of people who all they have, say, is just P60, P11D, bit of bank interest and maybe some pension contributions, they'll pick up all that information. And effectively, it will then be possible for the individual to log on, see their account, make sure everything looks correct, and then click on a box to say, yes, that's all correct, and I confirm that. So that's what they mean by doing away with the tax return. If you're a higher rate taxpayer, you've got quite complex affairs, then you can then add in the additional information, because it won't pick up things like rental properties, overseas income. There's a whole range of things that the revenue can't get directly. And what they've also said is that rather than just paying one instalment in January or two instalments January and July, you can actually pay as you go along. So it's to ease the cash flows. Although in practice I suspect a lot of people want to pay any sooner than they actually need to. And it's also possible to give your agent access. So for those that who have their tax returns done by an agent, effectively that can still carry on. In terms of when this comes in, it's going to start off in early 2016. There'll be a number of people go into it. And by 2020, everyone should be on it. That's the plan. In terms of whether it's going to work or not, I guess the issues are that the government or the revenue don't have a brilliant record on their IT implementation, so I can see possibly delays on that. We've seen similar things in other situations. We've also got the situation on how accurate the information will be. One thing we do find is we get inquiries opened on clients, sometimes on, say, bank interest, and actually it's based on the fact that maybe the revenue got the incorrect information from the bank. So, and I don't know how they're going to deal with that if the wrong information's been picked up and someone clicks and confirms it. So there are going to be issues around accuracy. The other thing that is important is a lot of people just don't use the internet, and paper returns are still going to be available for those. So I think we're going to see some savings, but in practice, for most people, all that's going to happen is that some boxes will be populated on a return, so it'll just be very slightly easier. In terms of national insurance, there's been a couple of announcements on that. If you're self-employed, you pay something called Class 2 national insurance, which is £2 something a week. What the government have said is they're going to abolish that over the course of the next Parliament. Self-employed people already pay Class 4, provided their income is enough. So they're going to simplify the system rather than having 2 levels of national insurance. There's going to be some consultation come out on that. So that's personal tax. It's fairly quiet on the personal tax front, but if we look now at savings and investments, one of the big announcements was the Help to Buy ISA. And what they've said basically is if someone puts in, say, £200 to an ISA and you're a first-time buyer, then the government will add £50. They'll basically add a quarter of what is contributed by the individual. The maximum amount you can use through this is £12,000 you can put in, and the government will top up by £3,000, giving you £15,000. And that's coming in for 4 years from the autumn. The banks need a bit of time to gear up for it. The starting level is going to be £1,000 initial deposit. One important point is this is going to be per person. So if you've got a couple buying property together, they could each have one of these accounts. So effectively get a maximum of £6,000 contribution to the house. So I think it's the parents who may be looking to help children, could be worth routing the money that way, rather than maybe lending the children money or just gifting them money. In terms of the total range of the bonus, say it's between £400 and £3,000. In terms of the limits of the house purchases, it's £450,000 for London and £250,000 outside London. So it does buy some quite substantial properties. And in terms of the timing of when the bonus is paid out, it will pay out when the house is bought, so it doesn't get paid out as you go along effectively. So that's the Help to Buy ISA. The other big announcement was around personal savings allowance. Now, we already have ISAs for people who want to shelter their savings from income tax. What they basically said is this almost operates outside that, where they have given an allowance of £1,000 worth of income, which will be tax-free for a basic rate taxpayer. So it's effectively going to be a £200 saving, being the 1,000 to 20%, or if you're higher rate, it'll be £500. £500 and 40% is the £200 again. If you're an additional rate taxpayer, i.e. your income is over £150,000, then you don't get any benefit from this at all. So that's coming in quite shortly. Now, one of the issues that we would have if they didn't change it is the fact that banks and building societies currently deduct 20% tax from interest. So everyone will be getting their interest and having to make tax reclaims. They've picked up on that issue. So what they've said is that from the point this starts, which is in April 2016, a year's time, then banks and building societies will stop deducting that 20%. So that potentially is going to be a little bit of an issue for those that get interest in excess of these amounts or are additional tax rate, additional rate payers, because they'll end up paying a bit less through what they receive from the banks. But they'll have a bit more going through their self-assessment effectively because the receipt of the interest grows. Annuities, this has been talked about for a while. When they brought in the pension changes last year, we had an issue in that people who'd already bought annuities couldn't benefit from the fact that you could effectively just take money out of your pension, pay the income tax on it, but receive it effectively up front if you wanted to. What they've said is that you can effectively now sell your annuity. So I suspect we're going to see a market building up in these, and effectively the annuity is sold, so the income stream is sold in exchange for a lump sum. Then that lump sum could be drawn out or put into another type of retirement product. So that's coming in a year's time. There's been a few changes to ISAs. One of the things that people are looking to invest in with trying to get higher interest rates is bonds in smaller companies. They tend to pay quite a good rate, but you couldn't ISA those previously. But what they're saying now is you can do for smaller companies. So that's going to be useful for those trying to seek higher levels of income, possibly at a higher risk. You can also invest in equity securities in crowdfunding platforms. So that's getting more and more popular. Come across a number of people who've looked at these crowdfunding platforms. Also the peer-to-peer loans, this was announced a year ago, but that's moving on. So the peer-to-peer loan companies, of which there are a number, there's an awful lot going through these. Hopefully within the next 12 months or so you'll be able to do those through an ISA. There's some further replies to the consultation which should come through in the summer. They've also introduced a relief where you can dip into your ISA, take some money out, as long as you put it back, I believe by the end of the tax year, then you don't lose the sort of ISA status of that money. So that's ISAs. So if you're looking at pensions, one of the big announcements is that they've looked at bringing down the limits from 1.25 million to 1 million. I remember when it came in about 2006 time, the limit was originally 1.8 million. They promised at that stage they would index that up with RPI. So it's come down quite a lot, 1.5, then 1.25, and now down to 1 million. So that is going to have an effect on more and more people. If you go over the million, you're able to protect the fund, but that will mean probably not making more contributions to the fund from the point of protection. Or if you do go over and you don't protect it, then there's a higher tax rate that applies to part of the fund on extraction. They have said they're going to start indexing it with CPI from 2018, but there's been so many changes, it's hard to predict where this will all land up. The change to £1 million is coming in 12 months' time. Inheritance tax, they did announce deed of variations are going to get looked at. Now, I don't know if that was a slightly political move, given Ed Miliband's sort of brush with deeds of variation, but there's likely to be a consultation in the autumn. It's not one of the things where I see generally as being too aggressive, so I suspect it could go right through and there'll be no changes. But I think the point to highlight is it does make it more important to think about wills carefully, because I think sometimes families take the view that if it doesn't quite work for inheritance tax, it can get sorted out afterwards. But in practice, we could lose the ability to do that in an efficient way. So I think if people are doubtful about whether their wills work for inheritance tax, it's worth getting some advice just to make sure that they won't need varying effectively. Just to pick up a medley of a few of the other more minor points that cropped up. Farmers averaging, that's currently over a 2-year period, that's been extended to 5 years, so we've got quite a good extension on that, so that's going to be good news for farmers generally. There are also some changes to VCTs and EIS. They're not huge changes, but generally they're trying to effectively encourage newer companies, and for those that have been running for a long time, more than 12 years or so, it's going to be harder to claim the reliefs unless you can show that there's been changes in the business and so on. And there are a few other minor tweaks to them. There was also an announcement of personal service companies, umbrella companies, because people are using them to artificially allow claims for travel and subsistence where you wouldn't be able to if it's an employment type relationship. So we'll see a bit of legislation on that shortly. So we move now to capital gains tax. Entrepreneurs relief, there's been a couple of changes. There's been a bit of speculation things could change on entrepreneurs relief, but actually the changes are fairly minor and are really just to deal with a couple of tax planning type things where the rules are being used in ways in which they weren't properly intended. There was basically a mechanism where you could set things up in a way where it was effectively set up as a joint venture where you get the entrepreneurs relief, where you shouldn't really do under the way it was intended, so they blocked that. There was also a mechanism where if you had a personal asset and it was used by a company and you sold a very small, tiny percentage shareholding of the company, then you could get a relief. So they've changed that to make it clear it's 5% of the shares have got to be sold to make it a material disposal. I think a lot of advisors thought that was probably the case anyway because the rules weren't that clear, so this just puts that beyond doubt. One of the other changes, this was announced in the autumn statement, but it's come in already effectively, but it was reiterated in the budget document, is goodwill on incorporation. It's one of those things that wasn't seen as being particularly aggressive. What used to be the case is if you had, say, a partnership or a sole tradership, you used to be able to incorporate it by selling the goodwill to a company, and then you paid 10% tax because you have your entrepreneur's relief, and then over the next few years you could extract profits from the company using the loan account created by the sale of the goodwill to the company. They blocked that, and they basically said you couldn't claim entrepreneur's relief in that circumstance. The other change is that you used to have a rule that basically said that if you sold your business, for example, and you had to pay capital gains tax, but you had entrepreneur's relief, then if you rolled the gains into, say, EIS, then you'd lose the entrepreneur's relief when it came out of the investment. What they've said now is that you can keep it. So if you have, say, £100,000 gain, you pay 10%, £10,000 of tax, you could invest that £100,000 effectively into a EIS business, and then when it comes out, you pay the £10,000 at that stage. So you're effectively keeping the benefit of the EIS. And a number of people do have other businesses they want to put things into and just gain the benefit of the deferral and possibly reduce the risk on the reinvestment. The rules for non-residents coming in shortly. This is the rule which basically says that for a non-UK resident selling a residential property in the UK, they will have to pay capital gains tax of either 28% or 18%, or possibly 20% if they operate through a company. So if for people in that type of position, it's going to be a question of getting a valuation of the property either now or at the time they sell it. There's 2 or 3 different ways in which you can work the calculation. And they're also looking at main residence relief, because we do have people, for example, who may have a property, say, in Spain, and they may, for example, make that their main residence because they may take the view that's more likely to be sold and that's what they want to claim it on, or you get a foreign resident claiming a UK house as their main residence. What they're basically saying here is that if you've got a house in another country, you've got to spend 90 days plus on a regular basis to be able to claim main residence relief. So that's personal tax and savings and capital gains tax. So if we look now at measures for businesses, first thing, just a reminder, the corporation tax rate is going to drop to 20% in April 2015. Mary in a moment is going to look at the policies of other parties on this area, but that, as things stand, is what's going to happen in April. And also we're going to see a simplification of the associated company rules, because at the moment you've got a fairly tortuous system where they look at other companies that are owned by the individual. But after April, they're basically saying that unless it's in a 51% group, i.e. it's a subsidiary company of your other company effectively, then it doesn't count as associated. So we're going to find some people who've maybe got 2 side-by-side companies won't be associated after we get to April. But having said that, the rate of tax is going to be 20% across the board, so it's not going to make that much difference in terms of working out rates and marginal relief. But the one thing where it does help is going to be quarterly instalments, where sometimes people have a number of companies, and at the moment they have to pay their tax quarterly, and that would drop out because they haven't got so many companies counted as associated after April. Cap allowances, this is one that people really need to have quite an eye on. And I know before the budget, one of my top predictions was they would announce an extension to the £500,000 annual investment allowance. In practice, they were actually pretty silent on it. All he said is that he regards the £25,000 limit, which is what it will drop to at the moment, because the £500,000 is effectively a temporary increase. He regards that as being too low a rate. And he said that in the autumn he will announce a new rate. So we're very much down to whoever the next government is and what their policy is on this. I have found that with the £500,000, most clients are able to get a straight tax deduction for anything they spend. And it has been really good for cash flow over the last few years from a tax point of view, especially when combined with the low corporation tax rate. But so it's worth looking at time of expenditure, and it's also important not to. It's important to make the point that you can't spend £500,000 up to December. It depends on your year ends. But you may find as you get nearer the date, your actual limit, because it's a pro-rating of the before and after, is actually going to reduce. So if you're going to spend money and you're relying on the tax relief to fund it, then get some advice before you spend the money. I've just summarised there what the rates look like, so you can see how it's spiked in recent years to the $500,000 and how dramatic a drop it's going to be next January. In terms of corporate tax, I talked about the incorporation and the goodwill and the entrepreneurs relief. There was another change as well in the autumn statement where they basically said that you couldn't claim tax relief because you used to be able to get your 10% rate on selling the goodwill to the company, but you could also get 20% tax relief in the company for the write-off of the goodwill. And they've stopped that as well, effectively, so they've almost done it on two sides. So that's worth being careful of. There are one or two situations where people can go into this inadvertently, so it's worth being quite careful if you're buying another business. R&D tax credit, they've announced this will go up from 225% to 230%. Quite a valuable relief. Basically, it means for every £100 you spend, you can get £230 deducted through a tax computation for tax purposes. And you can actually get a tax repayment as well if you haven't got profits. I do find there's an awful lot of businesses who don't regard themselves as carrying on R&D, but they're just doing little things on the manufacturing process. And you look at it and you realise they can actually make a claim and get some money back. So we've done a huge amount of these over the last year or two. And you get very little resistance from the revenue, so it is quite a popular and valuable relief. So if there is anything you do where you think, that's a little bit innovative, I've had to think about it, I've had to try one or two different things to solve the problem, it's worth thinking about whether R&D relief can be claimed. Because a lot of people are uncertain or sceptical as to whether what they did would qualify, they have introduced an advance assurance process, so you can write to the revenue and they will confirm whether or not it actually qualifies. One of the other changes is business rates. That's been talked about for a while. We thought we might actually see some changes, and there are a few minor changes coming in shortly, but the big change is going to be, I suspect, in a year or so's time. What they've said is there's going to be, to quote, a wide-ranging review carried out, and that's going to report back in a year's time, Budget 2016. This does seem to have pretty strong cross-party support, so I suspect whoever gets in is going to just carry this on. And I think what they've realised is that the current system, it doesn't take account of the economy, so if the economy is bad, the rates are still there, and that can help drag businesses down. Also, you've got issues where, for example, you've got shops competing against internet-type businesses, and there's more, so it's basically just trying to sort of square those type of things effectively so they're not at too much of a disadvantage. And the final thing that I'm going to announce is the so-called Google tax, which is the tax on diverted profits. This is basically the situation where if a company like a Google operates in the UK, often what would happen is that they would set up maybe a Luxembourg company or whatever, and that would charge, say, royalties into the UK, which would be deductible in the UK, so it would leave very little profit actually taxable. The other route they would take is they'd argue they didn't actually have what's called a permanent establishment in the UK, so they weren't taxable here. So what they've basically done is they've said, well, if you are making real profits in the UK, then there's going to be a 25% tax bill on that, which is higher than the normal corporation tax rate, and it's deliberately so to try and encourage people to set up proper entities in the UK. The only slight concern is they've said it's only likely to raise £1 billion over the next few years. But when you look at the amounts of profits that multinationals are actually estimated to be making in this country, it's only a tiny fraction of that. And it is quite difficult for us to unilaterally govern these things, simply because most of the reliefs rely on international agreements. So I suspect it's going to actually in practice be quite difficult raising this tax.